Okay. Once again, we'll start from the beginning. Yep. My name is Jamal Khan. I'm a senior tax partner at Churchill Tax. We all know about the new corporation tax rates and how painful it's going to be for many companies. However, because I've been doing this for a very long time, and we've had this is not the first time we're seeing the new kind of the two rates of corporation tax. I think what's important is to understand how you can, what steps you can take to mitigate the corporation tax rates. I will, so this is a little bit about us in terms of what we do. We do a lot of tax planning, inheritance tax, corporation tax, capital gains tax, onshore tax planning, offshore tax planning, and we do tax investigations, part of practice 9. So this is a little bit about us. Okay, so the new rates that we have from 1st of April 2023. So we've got a couple of rates now. So we've got a 19% rate for companies with profits below 50,000. And we've got a 25% rate for companies with profits in excess of 250,000. There's a third very naughty rate, 26.5% for profits between 50, the marginal rate. And if anybody remembers the good days before 2015, 2014, when we used to have two rates, and how painful it was. Now things are back. Okay, so these limits are apportioned for associated companies. So if you have two associated companies, this will be 25,000, and this will be 125,000. So the small rate will be 25. And if you have three, that will be apportioned further. And the limits also apportioned for shorter periods, where you have a 9-month period or a 6-month period. The rates are apportioned. Okay, so associated companies. What is an associated company? It could be company part of a group, for example, a parent and a subsidiary, or a parent with 2 subsidiaries or 3 subsidiaries. Okay, so that would be, with 1 subsidiary, that would be 2 associated companies. With 2 subsidiaries, that would be 3 associated companies, and so on and so forth. So that's the first one. Second one would be companies under same ownership. So, for example, if I own 6 companies, I would have 6 associated companies, even if they're not part of the same group. Okay, so that's important to consider. So if I have 2 companies, then I will be having, those companies will have 2 associated companies. So when you fill in the corporation tax return, now it will ask you, are there any associated companies? So if you have 1 associated company, you would add 1. If you have 2, you get the picture. So the rates will go down. So these rates, also these thresholds will be divided. So if you have 2 associated companies and the profit is, for example, £100,000, or profit is 60, let's call it profit of £60,000, okay, or profit of £40,000, call it, okay. Even a profit of £40,000 with 2 associated companies will be taxed at 26.5%. And that's scary. That's scary. That's very scary. So you've got to be mindful. And so I'm not too worried about the 25% rate. I will talk about this. I will give you some planning tips for that as well. But what you should be worried about is this rate, the 26.5% rate. What can be avoided. And to an ordinary person, this may not seem anything, but when you work the numbers, it does have a very big impact. Okay, so let's look at the. So we've got, as I said, we've got 2 associated companies. We've got under common control or part of a group. The limits are 25,000 and 125,000. Okay, the shorter period, I've discussed this before. So yeah, if it's a shorter period, you will reduce the limits as well, the threshold as well. So one of the tax planning options that you can apply this year. So if you've got any income that, for example, relates to, and if you've got a period that straddles the 2 periods, the two rates, or if you've got a year ending of, say, 31st of March. If it's possible, can you recognize some of the income in the previous year? If it's possible, because you might have already done some work. Right? You might have already done some work. You might have already done some, there might be some WIP, or part of the contract might have been performed, part of the services might have been performed. Are you able to recognize some of the income in the earlier period up to 31st of March 2023? If you can, that's the first thing you should do. Okay, as much as possible, because you're not going to get this chance again. But obviously, you don't want to do something which is not right. So make sure that you're doing something which people are, which can be supported if need be. You can raise an invoice. If you haven't raised an invoice, you're thinking, okay, you'll raise the invoice later. Or perhaps what accountants and solicitors have asked me, and I've been asked by different barristers as well. Well, if you were hoping to give the client, for example, some more time to pay, you could raise your invoice and give the client customers some extra time to pay, 3 months, 4 months, 6 months to pay, as long as some of the work has been done, or some of the work has been done. So that's something that you could consider. The second planning option is to defer expenditure to the new rates. So if you are falling within the two new rates now, or if you're falling within the marginal rate or going into the higher rate, and for example, say you're in the period to 31st of March 2023, where the old rates applied. Okay, so you would want to, as much as possible, of the profits in that period, and any expenditure that you could delay, for example, any pension payments or lump sum pension payments, or bonuses, or other payments to suppliers, or R&D credits that you could claim, or capital allowances, lots of other expenses that you could. But once you start thinking about it, you could delay a lot of expenses into this year, and you could potentially get relief. Rather than at 19%, you'll be getting relief at 26.5%. And that could make a big difference, especially if the numbers are big. Okay, just keep in mind that if you're paying a bonus, there's no particular change for employees on bonus payments. They will still pay the same amount of POIE and everything else. But for corporation tax purposes, that will make a big difference if the numbers are big. Okay. R&D credits, yes, you could claim. Yeah, you decide when you want to put your R&D credits in, or R&D capital allowances in. Same goes for any other payments that you make, which the directors can control. This is an important one, tax planning number 3. Intercompany invoicing. So for example, where you have associated companies, and one is falling in at, I don't know, at the 19% rate, and the other one is coming in at 26.5% rate. Okay. What you could do, and it's perfectly fine to do so, is you can invoice between the two companies, because there might be some services that one company is providing to the other company, but because you control both the companies, you haven't so far considered invoicing between the two companies. So if one company is being taxed at 26.5%, okay, and one of the other associated companies is being taxed at 19%, you would want to move as much profits as possible into the 19% company, as long as you don't take it over the threshold, because if you take it over the threshold, that defeats the purpose. But you could move profits between two companies, essentially, as long as you can justify that there is a contract and services are being provided and it's all legitimate and it's all genuine. Okay, but this is very important, and I've been asked by lots of different business owners and accountants how we can, but as long as I mean, yeah, there might be VAT implications, but think about the VAT implications. As long as both the companies are registered for VAT, you've got no problem. One of the companies might be registered, one of the companies might not be registered, but as long as you think about the VAT implications, you could potentially move some profits around. The next option for tax planning is to reduce associated companies. So, for example, during the last 8 years or 9 years, where we've started seeing single rate of corporation tax, which has been quite low, we have people have not kind of thought about whether we need to have so many companies. So it would be normal for people to see several companies, but now is the time to reconsider how many companies each person has, or there are in a group. Because, for example, if you have 5 companies in a group and they're all doing a little bit of services, so the lower rate comes down to £50,000. Essentially, everything's going to be taxed at quite high rates. So you might, or if you've got 2 or 3 companies, but your overall profits are not very high. If you're making profits of over £1 million, say, for example, or a lot higher in generally all the companies, your profits are higher above the higher rate threshold, I mean, there's nothing you can do. But what you can do is to avoid companies which fall within the 26.5% rate. So if you've got any companies which you don't need, maybe think about closing them down. Or if they become dormant, it doesn't have to be close them down, but you can completely ignore dormant companies for the purpose of associated companies rules. Passive holding companies, they're not considered as an associated company. Dormant companies are not considered as an associated company. So as long as they go dormant, they don't need to shut the company down. But you should be able to prove that this can be done. In my experience, so deferring expenditure to the current period can be quite a useful one. Intercompany invoicing. Intercompany invoicing can be very useful if you do it carefully enough. Okay. And the next, this also brings back the old memories or what we used to discuss with clients in the past. Was whether they should stay a sole trader or limited company, because now the rates have gone up. And is it worthwhile? Now, if you do the numbers pound for pound, it is much more effective to remain a sole trader. It's a lot more beneficial. So, for example, if somebody had £100,000 profit, is it better to operate through a limited company or a sole trader? Up until March 2023, we could say yes, it's better to go through a limited company, or what we had in the past to limited company. But now, if it's a sole trader, now it's a sole trader versus limited company. Now with the new rates, it's cheaper to operate as a sole trader. However, that said, that is on the basis that if you have a limited company, if you extract all of the profits, all of the £100,000 profit as dividends or whatever, then in that case, the sole trader is a cheaper option. But if you extract, say, £40,000 or £50,000 of the total profits and retain the rest in the limited company, in that case, limited company becomes a more viable option. So that the whole kind of debate of whether sole trader, and we used to do spreadsheets, and I don't know if you guys have those memories, but the spreadsheets of limited company versus sole trader. But now, I mean, my advice to the clients is simple. If you plan to take out every penny of your income, then it's better to remain a sole trader or close the limited company down and start as a sole trader. But we also have to advise the clients about the risks they carry operating as a sole trader. And for that reason, I very rarely advise clients to operate, or customers or business owners to operate as a sole trader because of these risks, the tax risks, if anything had gone wrong. The amount of, I mean, we also specialize in tax investigations. And where there's a limited company and there's a problem with HMRC, or there's a problem with, well, there's a lawsuit, or somebody's made a claim, or something has gone wrong, and we can simply put the company in liquidation, and that's it. That's mostly the end of the matter. But if you're operating as a sole trader, that can be very painful, because I have seen people go bankrupt. I've seen people lose their houses. So yes, you could save a couple of pounds here or there with the sole trader versus a limited company, but it's sole trader carries a lot of risks in the short term and the long run. In my view, very few people should, or nobody should, operate as a sole trader. Limited company gives that protection, because you could potentially, if you operate as a sole trader, there's a problem with HMRC, which you haven't done anything deliberately, but the point is that somebody's made a mistake somewhere. You could potentially lose your house. So that's something to be careful with. Right. Okay, and that's me. You've got my email address there, and you've got my telephone number there as well. My secretary will send you the slides. Okay. But if you would like to see, if you've got any questions, you can ask me now, or you can send me an email. Also, if you would like to receive any CPD certificates for attending this session, please do let my secretary know, and we'll issue you with CPD certificates for this session. But these slides will come to you, and normally people come back to me with questions not related to this or any other question related to tax matters, tax planning, inheritance tax, offshore taxation, capital gains tax, mergers and restructuring, reconstructions, anything. Then you can get in contact with me, and I'll be more than happy to help. Okay, so I'm seeing there's no questions, and thank you everybody for joining. Thanks a lot. Bye.